So today's Cardinal lesson, we're teaching you about the Multi-Year Guaranteed Annuity, MYGA, and they're called MYGAs. And for those of you that like acronyms, and it's a type of annuity. We're showing you some examples today, and we're showing you these are just some of the offerings that we have and the interest rates and the terms, and we're going to be going over those today and what these things really are. They're just a tool. They're a type of annuity, and they're a tool that we use in certain situations to help clients out. So I want to put it to Tom, and I want him to share with you why we're doing this video today.
Yeah, we're doing this video because many of you, the fear of loss far outweighs any joy of gain that you have. And these MIGAs are a wonderful tool to get a guaranteed interest rate with no market risk, no risk of loss due to the fluctuations in the stock market and the bond market. It's just all guaranteed from day one. And so they're a wonderful tool when you have someone who's interested in that. So let me bring up the show notes. Again, today's notes are pretty light. You can find these at the link below our video. They're also on our website. We just have the board. Again, a lot of people will print this out. It's a little bit bigger if you're watching on your phone. It's probably hard to see some of these numbers. You can print it out, take notes, reference back to this. I will point out that these rates do change somewhat frequently. And so depending on when you watch this, the rates might be slightly different. Depending on the state you're in, they could be different. So, don't look at this and say, I want this one exact when it could be slightly different by the time you call us. But the idea behind it still holds. It's still a really good tool. So I'll turn it back to Hans here, and we'll just jump right in.
Okay, what's listed on the board is just two offerings at each term. Okay, and like it says down here on the bottom, not all of these companies are in all 50 states and DC. We are licensed in all 50 states and DC, Tom and I are. And then we offer MYGAs, or multi-year guaranteed annuities, in all 50 states and DC. I just want to be clear that these offerings, since these videos go out all over the country, not everything in here is available in every state, okay? But there will be some alternative there. Now, what we've listed is the shortest term we offer is 2 years. And I guess if you look at the definition, multi-year guaranteed annuity, multi-year means 2 or more. So the shortest one, and there are a few that actually offer a 1-year term, but I didn't put them on the board. And so the 2-year term, and you'll notice that these pay the lowest interest rate. We don't have too many people buy the 2-year term because you can get a better interest rate at the 3-year typically. And it's enough better that people that are going to just put it all in one, they're going to go 3 years before they go 2 years. But where we do sell the 2-year term is when we're setting up one of these MYGA ladders that we're going to talk about in a little bit. And the MYGA ladder, it's nice to have that first money available 2 years from now, and then 3 years for blah, 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 blah. So we've got 2 years, got two examples, 3 years, 4 years, blah, 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 all the way down to 10 years. And people that do these ladders with these things, they're typically going to buy 2, 3, 4, 5, and 6. Okay. And we'll tell you about that in a minute. And this is just showing you an example. And if these are too small to read, the most popular term when we just sell one MYGA at a time, one multi-year guaranteed annuity at a time, is 5 years. It just seems like that's where the interest rate tops out. And that seems to be, there's a lot of people that have been in 5-year CDs in the past. And there's a lot of bank CD money that's moving its way into these multi-year guaranteed annuities for a number of reasons. But one of them is the interest rate. Is these are pretty competitive interest rates that the insurance company, and there's like a market of these things where they all know what each other are paying and they're all shuffling to try to be the best. It's just like the banks competing with each other. Within the MYGA market, there's quite a market in this, and we have a number of companies that we're licensed with, that we get most of them from the same place. So we're able to pull, and as companies change their interest rates, the names up here on a chart like this are going to move around. So let's talk about a couple of the features and benefits. Is that, for starters, the interest rate is level for the entire term. So the interest rate that you get, like if you buy a 5-year MYGA from Nassau Life and you earn a 5.75% interest rate, when you buy it, that's quoted, and that's what it is, and it's in the contract, and it's going to be exactly that amount till the end of the 5 years. So I want to put it to Tom, and I want Tom to make a few comments on that.
Yeah, I mean, when you start looking at these interest rates, so you have 5.75% compounding over 5 years. I mean, it's a little bit less than 6, but that's guaranteed, right? I mean, if you were to invest in the stock market, could you get higher? Sure. I mean, you could have, if the markets are up, you could get a higher percentage, but that also brings in the risk of loss, right? You could also lose money during that, and that's why you're taking the risk. And so the question becomes, are you willing to take risk or just have something that's guaranteeing close to 6%, for the 5 years? I mean, it's just a lot of people would be happy with that return, knowing that they don't have to risk any of that. Now, again, where the ladder comes in, because everything has, there's trade-offs, right? And so what are we giving up to get these interest rates? I mean, it sounds really great. The biggest trade-off is the liquidity, right? If you put it in there, you need to hold it for the 5 years to get that. Now, a lot of them will offer like maybe 10% withdrawal features, so you can access some of the money, but a bulk of it needs to stay in the contract for those 5 years. That's where the idea of the MYGA ladder comes into play. And I know Hans will talk about that here in a little bit. But if we spread them across the two through 6, once this gets going, you have 20% of your money becoming available to you every year. Now, if you need it, you can cash it out, take that money, go do with it whatever you please. What most people end up doing is rolling it into the end of that ladder. So this gets going. That really solves sort of the liquidity issue of not having access to the bulk of your money. So again, you should never put all of your money in something like this, right? When we're doing this as part of a plan, typically we're just sectioning off a portion of it. Maybe it's cash that you don't need. Maybe it's money you're tired of taking risk with. Whatever the situation is, it can work really well. Again, it's just one of the tools that we use to get a guaranteed interest rate, no risk of loss, and you know what you have from day one. You know exactly what it will be at the end of the 5 years or 3 years, whatever the term is, because again, the interest rate is guaranteed. So it's a really, really useful thing. They're paying much better now than they were when interest rates were really low. So these are tied to what the interest rate environment is. And so back, during COVID, when interest rates, the Fed kept interest rates really, really low, these weren't paying nearly as well. And so these have benefited from the rising interest rates. Again, one of the benefits of having that ladder is you're buying some of those ones in those longer term interest rates, getting, north of 5.5%. What's nice about that is if interest rates do come down, which again, from a economy standpoint would probably be useful. Again, there's a lot of, I don't want to get into too much details there, but assuming they come down, as you're renewing these, they'll be renewing potentially in lower interest rates, but we have some still purchased at those longer rates when you first bought them, locking in those rates. So again, it's a really, really useful thing for someone who's worried about market risk or just has cash on the side, because these are paying better than CDs. They're paying better than savings accounts, money market accounts. These have better interest rates for them.
Okay, let's talk about that 10% a second. Is the 10% withdrawal feature is, with some of these, it just comes with it. With other ones, you have to pay for it. So instead of getting 5.75, you might get 5.65. But what comes with that is the right to take out 10%. Some of them let you take only interest, but most of them have a liquidity feature, and which is pretty unique to insurance, where you can pull out 10% in any given year without a penalty. And frequently we have people call us where they want to take more and they only got one annuity, and we're looking at their anniversary date, and perhaps their anniversary date, if we're sitting here in June and their anniversary is in September, well, we tell them we can take 10% now, and then the day after the policy anniversary in September, we can take another 10%. So that's 20%. but just by straddling the year. Um, those are some features where we're trying to get money back out of it. This will accept IRA money. Now, you can't mix IRA money with other money. So if you've got both kinds of money, we're going to have to sell you 2 annuities at least, but that's not a problem. Um, the interest is tax deferred until withdrawn. So if you put money outside of an IRA, you put them into these MYGAs, and you're earning this interest every month. You're not paying taxes on it like you do on a CD or a savings account. This interest is tax deferred, and it's only going to be taxed when it's withdrawn. And so that's potentially creating a problem for later, but you're not paying taxes on interest you're not spending. If we have people that are like working now and they're not going to retire for several years or a number of years, we can time one of these things to the year they retire is when it's going to come due, and we can use their non-qualified money, earn this good interest rate, and then that money will all be there and ready to do something with exactly when they're within the year that they're retiring. And then they can postpone income taxes during those high earning years while they're still working. The interest is tax deferred until withdrawn, and the cash value is paid to the beneficiary upon death. So, people ask us, well, what if I die during these 5 years or 8 years or whatever? Well, then this thing is going to be paid out to your beneficiary. And if it's in an IRA, we're going to work with your beneficiary to preserve the IRA piece of that and roll it over into an inherited IRA on their behalf. So there's lots of uses for these things. And I want to talk about the MYGA ladder. So the MYGA ladder, we just put something like this, in for this lady who's a widow and out of the life insurance money. And so if we had 250,000 of a larger sum that we allocated to this, because we also left $100,000 in a money market account, so she's got immediate access to buy things, do things, and we really have an emphasis because we set up a budget with her that she's going to be living off of the income stream. But then there's 100 grand just sitting over there that's liquid, so she's going to go to that first if she needs money. And then we divided the 50,000 or the 250,000 up into 5 units. We bought a 2-year, a 3-year, 4-year, 5-year, and 6-year for 50,000. And that means that every year starting in 2 years, she's going to have 50,000 plus accumulated interest available to her with no penalty. So if she wanted to draw the whole thing out, she could. But what most likely she's going to do in 2 years is just take that money and buy another 5-year that's just going to be right here. And so every year, 50 grand is going to come due, and she can postpone the taxes on the accumulated interest by just rolling it over and rolling it over. And then at some point, when she needs to start accessing this, she knows that every July she can get at it, and she could take out 10% of the rest of them if she had a big needs. So these ladders are quite popular, and we kind of construct them as part of a financial plan. So Tom, what do you have to say about the MYGA ladder?
Yeah, I mean, like I mentioned earlier, really what it solves a couple of the, I don't know, say issues, but downsides to the annuities is the liquidity feature, right? I mean, if you were to say, you look at this and say, hey, why don't I just put it all on a 5-year one, take the 250,000, buy the 5-year one, which you could do, right? Some people do that, and just get the higher interest rate and guarantee that. What you're giving up there is access to that money during that 5 years. Now, if you have plenty of other money and you don't really want to worry about it, then fine. Like I think a lot of people, we do sell a lot of those. But when we have someone who's concerned, like, I don't know what's going to happen 2-3 years from now. What if I need some of this money? Well, this ladder helps solve some of that issue where each year you have some of this coming due. And it's also a way to sort of lock in those longer interest rates, given the high interest rate environment we have now. So again, this isn't for everybody, right? It needs to be part of a larger plan. We need to make sure we do have enough money outside of these to cover, emergency expenses and just daily living costs. But if we have plenty of clients that have a lot of cash on hand, we can get a lot higher interest rates. And then to Hans's point, the interest is deferred. So, if you have, several $100,000 just sitting in a high yield savings account or a money market account, that's great. It's liquid. You can get it. But you're having to pay taxes on that interest that you're not even using. What's nice about this is let's set it aside, get a higher interest rate, get more earnings, and don't have to pay taxes on it until we actually need it and pull it out and live off of it. So again, it's a tool, and it's a very useful tool that we can build as part of a larger plan.
Okay, within the scope of comprehensive planning, we really didn't talk about Social Security or Medicare or long-term care. We did talk about IRA because we put a fair amount of IRA money in these things. We talked a little bit about income because you can create an income out of a ladder. We talked a little bit about estate, and I just want to emphasize what I think people like is all these MYGAs or multi-year guaranteed, they have a beneficiary on them. So you can have this money as your kind of mattress money that you're managing, and then you can name your beneficiaries accordingly, and this is going to pass right to them outside of probate. And then we talked a little bit about taxes and the tax deferral. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.